So today we will talk about investment towards the future. We have here today with us Mark McCombe. He's the Chief Client Officer of Blackrock, and he's responsible for overseeing all global client segments. He also serves as the head of US, Canada, and Canada region, and he also oversees the multi-asset strategy and solutions group within Blackrock. So he helps clients take a holistic approach to portfolio construction and asset allocation. He has a long career in the financial sector. Before Blackrock, he worked many years for HSBC. Asset management has always been under his scope. So he has a very long career in the sector and a lot of experience regarding asset management. A lot of discussion has always happened regarding retirement savings, regarding pensions, whether life expectancy, whether interest rates, whether asset allocation have to change during times. In the recent past, we have particularly seen an important reduction in interest rates. So that together with a larger proportion of asset allocation towards alternative investments and the role private equity has increasingly played, it's a very interesting time to have a discussion with you, Mark. We really appreciate being able to talk to you today. And I want to start with the first question that involves some of these elements. No? As Chief Client Officer of Blackrock, you interact with many customers and with CEOs, CIOs, CFOs, treasurers of many companies, very large companies in the world. And all of them have similar questions. What we should be doing next, where we should be allocating our assets. No? So from your perspective, what are the most important themes in the conversation today?
Well, Manuel, great to see you, and thank you to the Amafore for inviting Blackrock along. We're very proud of our business in Mexico and thrilled to have this opportunity to tell you a little bit about what we're seeing globally. It's been an extraordinarily interesting 18 months. You asked in your question about the conversations I have with clients globally. And I would say rightly that CEOs and CFOs and capital allocators really for the first 12 to 18 months of this pandemic were rightly focused on really resilience around their businesses, resilience around their employees and the people they were responsible for. And then I would say ultimately communicating extremely effectively with the stakeholders and participants, whether it's in the pension plans or the corporate plans or the foundations and endowments. And so I would say that this period that we had with real central bank coordinated support of the economies and giving a sense of real underpinning of the economies allowed all of these companies and capital allocators to really work through the pandemic. So to some degree, having this conversation here as we head towards the end of 2021 is really, I would say, one of the most interesting and to some degree challenging periods of this pandemic. And in the conversations I have, really there are just kind of, I would boil it down to sort of four topics that are very much preoccupying the minds of capital allocators and CEOs the world over. And the first is, what does the future of work and the future of the organization of the world look like in a post-COVID world? What have we learned? What has changed permanently, and what will kind of revert back to, pre-COVID practices? And things like working remotely and working flexibly. These are all things that I think many people are very, very focused on. Secondly, when talking more deeply about investment management, of course, there is really only one topic today, which I would say is kind of obsessing people at the moment, and that's really the question of inflation. You mentioned low rates and the low rate environment as a result of a significant central bank support. But of course, what we're seeing on the flip side, which is I think the part that is really the unknown. We've never been through a global pandemic in modern history, and therefore, one of the great things about the Great Resignation the lack of supply of labor, the fact that we're seeing supply chain disruption and concerns about China and trade, all of which we can talk more about. But all of this is fueling this great debate around inflation and what it means in terms of portfolio construction, portfolio resilience, and portfolio allocation. So I would say that that is a dominant feature. That's the second one. The third you mentioned in your preamble, I'd like to broaden the aperture a little bit. I think it's a world where the great kind of retirement crisis has only really gotten worse during the pandemic. Now, asset owners have done very well. The equity markets have been buoyant and people have had good returns from private markets. But the reality is that the world is not saving enough for the retirement that people want to enjoy. People are living longer. The social safety net is not there. And if the pandemic did anything, it shone a light on the inadequacies of government to really be able to actually provide that long-term security to the citizens that they're responsible for. And so we believe that that question of where do you find yield goes well beyond pure private equity or pure alternatives. It really is, what are the alternative sources of alpha that I need to build into my portfolio? But by the way, recognizing that liquidity when we had the shock of the pandemic was really, the number one factor. And then finally, the fourth point, which again, I know we'll talk more about, but the biggest question I think that I get asked away from inflation, which I would say inflation is a kind of very present issue, but the real strategic, the real tectonic shift is not so much, the question of climate risk is investment risk, but the question is how do I build sustainability into my portfolio, and how do I make my portfolio resilient for a future in which across all of the measures of E, S, and G, we're going to see significant change. And here I would argue, just to finish, Mexico and Mexican Afore have been very much at the forefront of this. And frankly, we in the US and Europe and other parts of the world are learning from the steps that the Afore have taken in terms of actually building ESG factors into their portfolios.
Thank you, Mark. I think we can jump there. One of your comments was on yield, people looking for yield. What we had last year was something that, as you mentioned, we had never lived before, the pandemic. You have experience in pensions. From your perspective, thinking on pensions, which is the reason we are here, the Afores, we have to make the contributions of our clients grow so that they can get that money for their retirement. What can be viewed as the largest change in the retirement space since the pandemic? How have your customers evolved their models after the shock we had last year? We did great. We certainly did great. We had the best result in any single year since the Afores were created. But clearly, that was part of the consequences of the shock. But there are many other things that changed in our perspective, in the way we do things, in the way we see the future. What are those changes for you?
Well, it's a great question that I ask myself every day, is like, why in the middle of, one of the most difficult and challenging periods for humanity did we emerge pretty much consistently across the board with outsized returns across pretty much every client channel? And I've sort of taken a step back and thought about it. We've talked about the central banks globally stepping in a coordinated way to underpin the economy. I think that gave an incredible amount of confidence. Once people figured out very quickly that they could operate quite successfully remotely and that business could continue indeed to turn, I think we realized then that actually the global economy was in really pretty good health. And I think that's where we started to see this kind of asset run up. So I think the answer to your question about, what has, fundamentally changed, I would say that the reality of what I observed for the last 18 months is that, and it sounds a little cliche, but it's important, I think, to do a double underline on it. Getting your strategic asset allocation right is critical. And then doubly critical is sticking to your strategic asset allocation. I think the asset allocators that suffered were the ones who panicked in the early stages of the pandemic, because rightly, and I'm sure very well, the US public pension space is one that is structurally challenged because they're all very largely underfunded, which means that they have that liquidity draw that has a drain on their resources really on a constant basis. And so it means that the traditional method of taking advantage of the illiquidity risk premium, actually building illiquids into their portfolio allocation, actually became quite challenged for those few weeks because people worried about would they have sufficient liquidity. The pensions who had a very, very robust governance process around their long-term strategic asset allocation are the ones today who I think are in the best shape. And my conversations with many CIOs and capital allocators really focused around in that first period. Is there anything you need to do in your strategic asset allocation to take advantage of what is changing? Now, I think this is part two of your question, which is kind of what's changed. And I think it's that CIOs have recognized that within the context of a strong governance process around a strategic asset allocation, you need to actually also think about different risk scenarios that you're operating that strategic plan under. And so, for example, we saw in the space of private credit, it became a very good area for people to allocate into. It didn't change the long-term view of increasing your holdings in illiquids or increasing your exposure to credit, but it allowed a CIO to be more opportunistic in recognizing that there was a real opportunity to enhance yield by moving into something like private credit. Interestingly, we had a lot of debate internally around other asset classes, like, for example, secondaries. We actually thought the secondaries market would be very dislocated in the early stage of the pandemic because we thought a lot of pensions might try to offload private equity positions, and there may be a buying opportunity for those that were more liquid. Ironically, that never played out. And I think it never played out because for the vast majority of capital allocators, the rapidity, the speed with which the central banks acted allowed them to actually sort of, buffer down their, lock down their liquidity requirements more effectively than be sitting in a world of complete unknown where they felt they had to liquidate positions in a more rapid sense. So I think, long answer to your question, but I think it's like, make sure your strategic asset allocation is clear and strong and has good governance around it, but build into that different risk scenarios that allow you to take advantage when something like a pandemic or higher inflation or global supply chain disruption happens, where there may be opportunity to find those sources of alpha that you may not have been able to find traditionally.
Certainly, the pandemic gave an opportunity for those that had more flexibility because there were opportunities there. Let's go back to one of your first comments on alternatives. Clearly, alternatives have played an increasing role in many portfolios, but it's not general speaking alternatives. There are some particular alternatives that are more or less attractive. From your perspective, how did your customers see the opportunity set for alternatives changing in the coming years? Hopefully no other pandemic, but let's think how alternatives work in the portfolios. Are there certain markets or alternative solutions that clients are particularly excited about?
Yeah, look, it's an interesting discussion because the reality is there is a quiet revolution taking place at the moment, and that is that in fact alternatives are becoming less alternative, and the way in which people think about alternatives is changing. And so even the very discussion of what constitutes alternatives, whether it's hedge funds, private equity, infrastructure, real estate, private credit, all of these components of what you might consider to be alternatives in the traditional sense are becoming more mainstream. And, the realities of why they're becoming more mainstream is actually driven from, really to some degree, the evolution in society, probably accelerated by the pandemic. If you think about, for example, where alternatives are now sold, it used to be the domain only of the Afore and other large institutions who had buying power. Now, of course, we're seeing adoption amongst multitude of investors, including individuals who want a seat at the table. I have often argued with my colleagues that there's a kind of giant FOMO going on at the moment, the fear of missing out, and that individuals and actually institutions, they want earlier and earlier exposure to private markets because they see things like the Rivian IPO, which values a company that doesn't have any revenue at $100 billion, you see the opportunity for real, outsized returns. And I think that, combined with social media, combined with some of these really interesting anomalies that we've had with like Robinhood and so forth, have fueled a lot more interest in what we term alternatives. Now, what does it mean? First of all, it means that there's never been more money chasing after these kind of opportunities. That means that for big institutional buyers, the olden days where it was a case of like, let me just like diversify and work with dozens of managers and so forth, we find that has become a challenge model, because the reality is that the resource requirement to manage alternatives, we should think about it. The reason they are called alternatives is because they are not as liquid as other asset classes that you can quickly get out of. And so requires a different setup, a different organization, a different set of resources and skills in order to actually manage and grow a resource, an asset allocation into alternatives. And so that's definitely one of the things that when people ask me a little bit what keeps me awake at night, one of the things I do worry about is that invariably when you have a rush by people to get into certain asset classes, whether it's things like crypto or whatever, that what tends to happen is more and more money chases opportunity. That means that sometimes people can lower their risk standards, or the prices get out of what you would say was economically viable, and that starts to cause a little bit of a sort of a mean reversion where people worry about whether there's some sort of bubble going on. Now, I'm not for a second saying that I think that there's a bubble going on, but I think just when you have this phenomena where it used to potentially be the domain of just institutions, but now everyone is trying to get into alternatives, that just being very mindful of it, maintaining your risk standards, making sure that you have a clear process about what it is you want to get involved in, and don't chase the latest, greatest opportunity, because it may turn out to be too good to be true. And again, stick to your what you know well, and deliver those returns, which frankly, within the private market space, have been, really very strong over the past few years.
And I think that luckily for the institutional investors, as you mentioned before, our governance will, if we keep focus on the longer term, it is harder to imagine that we will make those mistakes. So as long as we keep that in mind, then probably someone else will get burned at some point, but we can't be the ones. We have to keep the focus in the longer term, and to look with that horizon in our investments. In that longer term, in that horizon, sustainability is a very important element. Every day, more and more important. How are you seeing the growth for sustainable investments among your customers, and what you expect in the longer term? Now, what are the challenges your clients are facing around sustainability?
Yeah, it's a deep and complicated question, and I would start it by saying that I myself feel like I'm on a personal journey with this, because a couple of years ago, if you'd asked me the same question, I would have probably answered it through the lens of sustainable product. And what are you doing on the product side? The reality is this has gathered a pace that I think has really surprised most on the upside. And that the conversation today, as I mentioned in the opening, is not about whether or not climate risk is investment risk, but it's really about how do I build sustainability or climate, either or both, into my portfolio? What are the tools I need to allow me to make the right decisions in exactly the way that we've done historically? The job of an investment manager is to seek alpha and seek returns for our clients. It's no different today from yesterday. The only difference is that we have a global problem that I think we are trying to grapple with and figure out the right way to ensure that we have sustainable growth for the economy, so that those people who are aspiring to come out of poverty can have that aspiration, that we don't stifle the very people who need our help the most. But that secondly, we go through a transition in our economy, probably the most important transition ever, which is to take us from high carbon emitting to a net zero world. And our strongly held belief, which comes back to my point about this is not about product anymore. This is really about the structure of how you manage your entire portfolio is really about what does the transition look like. So let me give you one very real world concrete example. We have deep relationships with all of the major oil and gas companies globally. We manage many of their pension assets. Obviously, we're a very large investor by virtue of our size. Of course, what they themselves are dealing with is a changing regulatory environment, and particularly focus around Scope 3 emissions, which, as you know, is really linked to the rest of the economy. You know, an airline is a Scope 3 emission. It's using the fuel produced by the oil and gas company. As we evolve and we think about all of the investment required and the resources required to actually transition a global economy, indeed, those oil and gas companies have to be at the table and they have to be part of the solution. Because if we simply say that divestment is the way to go, then those very companies that can help us grow the global economy and lead to transition will indeed suffer the most. So we have really, I myself, and I think, you know, many of my colleagues at Blackrock, I think we've been on a journey where we're really now seeing the capital flowing into strategies that are really designed to underpin ESG and actually set up sustainable growth for the future. And I think this is where Mexico and the Afore in Mexico really, as I mentioned, did a really good job of thinking about this early. I say to everyone, we're in such the early innings as the investment management industry because we, by definition, we are about choice. We're about very often managing to indices and managing on tracking errors. And so, in a way, our ability to have been influential in the ESG debate, I think, was quite limited historically. But as more and more clients, as more and more investors are looking for our industry collectively to really address this issue, I think it's critical that the conversation we're having today and multiple conversations that are going on like this around the world are driving towards an outcome where there's greater levels of transparency, there's greater levels of consistency of reporting, and therefore we give people the ability to understand how to invest into a transition economy as opposed to simply turning your back and saying, I just want to sell my oil and gas holdings and not have anything to do with it, which is not the answer.
Perfect, Mark. We have gone over some themes that are around all conversations, probably, no? And particularly this last one has been for a while. Some others probably were more closely related with the pandemic because everyone wanted to find out what were they doing right and what they should do differently. But there's one last question that I want to go over you. Thinking about disruptions, no? What are the most exciting disruptions that you are seeing today with regard to technology? And how is BlackRock adapting to and staying ahead of these trends?
Yeah, as you mentioned in the start, I'm based in San Francisco, so I am lucky to have a ringside seat of some of the most incredible technology and evolutions that I think we've ever seen. And what I tell you is the pandemic has not slowed down. If anything, it's, I think, sped up the focus on innovation and technology to drive change because people are, you know, the sheet of paper is very different today than it was 2 years ago. And so people have different opportunities. I think the way in which, technology has been able to thrive during the pandemic, I think has been one of the big sort of positive surprises out of this. You asked about some of the things that I'm seeing a lot of. I mean, we talked a little bit about sustainability, and I do think that the drive on electrification is one of the most interesting areas because, of course, it's not just about, you know, a Tesla or a Rivian truck. It's actually really about the whole infrastructure. Like, how do you change the whole infrastructure of an industry that has been entirely focused on petrochemicals and turn it into an electric grid? And so, whether it's the battery technology or supply, storage capabilities, these are all fascinating areas. The other area that I'm, particularly interested in has really been, some of the fintech disruption for obvious reasons, given that's our business. And what I would say is that we, when it comes to things like blockchain technology, digitization of currency, of the movement of capital, we're very much leaning into that. We have a great growth equity capability, and in some of our sort of long-term private capital capabilities. We spend a lot of time on technology. But I think that, the story is a little bit kind of clouded by people getting, they want to know what you think of the price of Bitcoin. But the truth of the matter is that is just one manifestation of, I think, what is really happening, which is the sort of digitization of the economy. And so, ironically, the way that I look at supply chain, I've lived in Asia and Europe and the Middle East. So supply chain has been in my blood since the day I started working, that, seeing the container ships in Hong Kong and, the transshipment that you would have and so forth, like that globally connected economy. As I think about a world where, there's been a lot of disruption, but technology can play a role to sort of bridge many of these disruptions that we've seen. And so whilst we're all very frustrated by what's going on at the moment and some of the geopolitical tensions that there are, I do believe ultimately that technology will drive back to a more globalized world in which people are able to deliver, high levels of efficiency and productivity through using digital technology to back ultimately their means of production.
Hopefully, what we have seen in terms of being able to interact with each other, to have a conference like this and like the one we had last year, deliver not only in our interaction, but also exactly in what you mentioned, the disruptions we had because of the pandemic, how technology can help solve those situations that created the problem and allow us to flow more fluently in the future. So, Mark, I really appreciate the time we had to talk to you. I think it was a very interesting opportunity to discuss what are the perspectives today for pension funds, for asset management, with your experience, with the work that you do through Blackrock and the interaction with your customers. And these will be topics that will certainly be touched later in this event in other panels. So I think this was a very good introduction for what will come next. Thank you very much again, Mark McCombe.
Thank you, Juan Manuel. It was a great pleasure.